After a choppy end to 2025, cryptocurrencies staged a remarkable comeback. Bitcoin rose to its highest level since mid-November, with analysts predicting it could hit a new all-time high by the end of January 2026. Bitcoin has been pushing toward the $100,000 level with strong momentum from institutional investors. US GDP grew at an annual rate of 4.3% in the third quarter of 2025, handily beating economists' expectations for a 3.2% increase. But here's what they're not telling. This strong growth is happening while the labor market is slowing. With payroll growth falling substantially and nearly 90% of net private job creation through November occurring in a single sector, healthcare and social assistance, the economy is being propped up artificially. Every major empire has faced this moment. Rome debased their currency. Inflation came in. The empire collapsed. Britain lost reserve currency status after World War II and devalued the pound by 50%. Now it's America's turn. Here's the real strategy behind crypto and why the government is so bullish on it. Stable coins create tremendous demand for government bonds. When Tether or other stablecoin issuers receive dollars, they don't keep cash. They buy U.S. Treasury bonds. This solves the massive problem that China, Japan, and other countries have stopped buying U.S. debt after what happened to Russia's reserve. Here's how it works. Say you're Tether. You issue these stable coins, and that means you receive $1 in cash, and you give somebody a USDT, which is a Tether stablecoin. You still have the dollar in cash. The dollar in cash doesn't make you any money. So what do you do with it? You buy government bonds because they're safe. And now you're collecting, say, a 4% interest, but it's not your money. So you're making free 4%. But from the government's point of view, what have they just created by boosting stable coins? They've created tremendous demand for government bonds. The problem is that China was the biggest buyer of US government debt. They're not buying it. The Japanese are not buying it. The Indians don't want to buy it. Why not? Because of what they did to Russia. Russia had foreign reserves in the US and in Europe, and those reserves got seized. So who in their right mind as a country would put their money into somebody else's country? So the only thing that you can hold at home is gold. One of the reasons I'm so bullish on gold for the next couple of years. Yeah, and why B, the gold miner, is positioned so well. The end game? A crisis that forces the transition to central bank digital currencies, or CBDC. Perhaps a banking system hack, some sort of major financial calamity that means the banking system doesn't work. ATM systems could go down and they'd blame the hacking on North Korea or something like that, because it's always North Korea, right? And then suddenly the government comes out and says, hang on, no worries, we got a solution for this. We're going to send you CBDCs into your phone and you can pay with it as normal and people will accept it. Problem, reaction, solution. Tale as old as time. Inflation is expected to cool to about 2.4% in 2026, according to forecasts, but that would still leave inflation above the central bank's goal. Here's what's really happening. Inflation erodes the value of money and debt. That $38 trillion becomes worth less. Meanwhile, inflation increases the prices of stock, real estate, and other assets that the wealthy hold. What happened in the 1970s? We saw massive inflation, and you know what else happened? Gold went from $35 an ounce to over $800 an ounce, a 22 times increase, and gold mining stocks did even better. That's the playbook we're looking at again. Let me give you a history lesson. After World War II, U.S. debt hit 106% of GDP, actually higher than it is today relative to the economy. How did they bring debt back down to just 23% by 1974? That's an 83 percentage point drop. Did the government pay it off? No, they inflated it away. From 1945 to 1951, the Federal Reserve capped long-term bond yields at 2.5%. Meanwhile, inflation was running at 6.5% per year on average. If you're a bondholder earning 2.5%, but inflation is 6.5%, you're losing 4% of your purchasing power every single year. Over 10 years at that rate, you lose about 34% of your purchasing power. Over 20 years, you lose 55%. Your bonds still say the same number of dollars, but those dollars buy dramatically less stuff. According to IMF research, real interest rates were negative more than half the time between 1945 and 1980. Financial repression and inflation accounted for roughly half of the debt reduction in the post-war period. Not growth, not surpluses, just inflating it away. This is going to happen all over again to a much larger extent. Today's government debt payoff playbook is identical to what happened after World War II. And it's going to destroy anybody with savings, anybody lending money to the government bondholders, and it's going to enrich people that have the right assets. So if you are a billionaire running the country, of course, I'm not suggesting that billionaires run the US. That would be laughable. Right? What do you actually want to do? You want to reduce the debt. So you cause lots of inflation, and at the same time, you'd like to get wealthier. You'd like your stock prices to go up, your property prices to go up. So what do? You cause more inflation. How? You print more money and you lower interest rates. What is the government doing right now? It's printing more money. It's lowering interest rates. Weird coincidence. Who does this affect? If you're asset rich, as in lots of money invested, you're going to do brilliantly. If you're a salary man, as the Japanese call them, you're going to struggle. What can you do? Move gradually into the direction of asset richness. And that might be $100 a week or a month invest. But the more you do it, the faster you do it, the better protected you're going to be. If you want a case study on it, study Japan. In Japan, the wealthy are very wealthy. They live a very good life. Everybody else is working on 1970s wages and is struggling.